plans that, or, from a wealth perspective to consider, some basic kind of tax strategies, and kind of lead us into what I want to, oh, wait, okay, I'll get it soon, guys. Okay. So, CLA, part of our logo, we have this bike. And I think that that's important to express because, right, you guys are on this journey. There's a lot of different journeys we're on, this journey of life, whatever. Let's call this the journey of your business. And so, we have this bike and it kind of, here it's very balanced, right? You're kind of in the driver's seat. And we're going to talk about things today that kind of help you balance that bike and some things that kind of make it imbalanced. And so, overall, the goal here is to empower you, just to be familiar with some of these basics and empower you to ask the questions. There are no wrong questions. Ask questions today, ask questions later. And other things that we're going to talk about. So here is just, we want to get back to basics. Like I said, we're going to discuss some just high level charitable and retirement planning, just basic points on estate planning, things from a tax perspective, current law, what to kind of watch out for, and honestly be mindful of and look at your own tax returns, ask questions. Also, I guess before we kind of keep going here, in terms of questions, I think we want this to be a little bit interactive. So maybe we're going to pause for questions, and see what kind of feedback we get along the way.
Yeah, Molly, what will happen, sorry to interrupt you, is that we encourage the women to put their questions in the chat. And then when there's a pause point, I'll mention those to you. So either of you can just answer those questions. Is that fine?
No, that is perfect. And if you don't mind, will you help monitor that?
Absolutely. Absolutely.
Thank you. Thank you.
You're welcome.
All right. So with that, Steve's going to kind of take it over and talk about some wealth planning.
Yeah. And again, welcome, ladies. We're thrilled to be able to do this. And you see, I was excluded from the hat and tea, so I feel a little left out. But I'm glad to be here today, if you will. But Danita, I know the question about some of the budgeting. I think some of these things we can get into later on in this presentation. So we're going to talk about that as well. Ada, I think you were kind of asking some of the same things with Stephanie, and some of our outsourcing in particular can be good places that we talk about. And, in this retirement plans, I'm going to hit on something Dawn suggested that, or said the purpose of QC DBIB is to take a dream and a starting point where we are today and blow it up and make it big. And so some of the retirement plans we're going to talk about that is just for that, for like Ada as you grow your subcontracting business there. But I think we want to get a couple of key messages out here for us there on this. One is a financial plan. And I think Ada was talking about it in the budgeting a little bit, and that's just kind of cash flow. But we'll expand that out. This is really important. Being young and being early in the business, developing a financial plan early on in this progress, taking a little bit of time to work with ideally a fiduciary-based advisor. Somebody's not necessarily trying to sell you insurance or sell you something. Working with somebody, and you can do it online if you're so inclined, but working with somebody to build a financial plan that says, this is where I am today. This is where I'm trying to get to in the future for myself, my family, my business, and having some trusted people, trusted advisors. We'll hit on this again at the end there to help you map that out. The great thing about doing it today, as opposed to waiting until you've hit the magical success number, is you got time, and little changes can make big, big impacts. And so I think we very often for business owners, we see, and we work with a lot of business owners, they're in the back half of their careers and thinking about the exits, thinking about retirement, thinking about legacy to their kids. And what was missed, and I want to stress here, is focusing on the future, focusing on where you're trying to get to with a little bit of time today in a financial plan can really have a big, big impact. Small changes today, small habits become big things in the future. And that could include the budgeting, and that can include cash management, and Stephanie can help on some of that there. But one of the things that comes down to the retirement plans, this is often a question that as Ada grows the subcontracting, the contracting business, and you're growing, and as Dawn's talking about just expanding and blowing this thing up, in years 2 and 3 and 4 of a business, You go from, kind of starting it out, in a small little shop, and now you got 5 employees, 10 employees. It's growing rapidly. And you say, okay, now what? One of the things I want to do is benefits for my clients or benefits for my company to retain and attract employees. And so retirement plans tend to be one of the next things that folks ask on. And what I just want to do here on that left-hand side is in very quick succession, very quickly, kind of talk about that progression, because clients tend to ask, I want a 401k, because that's what we're familiar with. Maybe that's what we had in a previous lifetime. I want to get a 401k for my company. Not so fast on this. More often than not, there's a couple of steps along the way that actually fit better than a 401k with a lot of complexities and costs oftentimes there. So, let me just kind of walk through and hit a couple of highlight points. And then if you want to follow up with this, we'll give you that opportunity on an individual basis. But let's walk through this. IRAs open to everybody. Great savings vehicles. You can contribute. Anybody can contribute to those. That's an easy way to kind of do it on your own. No complexity. Virtually no cost. Very easy. Next thing is, if it's just you or you and a spouse, you and a husband, you and a spouse, the only 2 employees of a business, an individual or solo 401k is a stripped down 401k that can allow you to make it easy contributions and have a lot of the same benefits as a 401k, just without the cost and complexity. So for a husband and wife or a spouse and partner, just the 2 of you, if that's your employees, your business right now, that's a great retirement plan for that. But now skip the next line there. You start growing, start having employees, or you come to Molly in 2025 and say, I had a great year. I got a bunch of taxes. What can I do after the fact? That's where a SEP IRA is a retirement plan that works. So if next year you come in and say, man, I knocked it out of the ballpark and I got all this taxes, Molly, what do I do? One of the suggestions might be, okay, one of the few things we can do after the fact is a SEP IRA. But that's when you have that's oftentimes when you have employees. You got to now start shifting beyond just the simple individual 401k to these SEP IRAs. For ADA with the general contractor, where you might have multiple employees, a SEP IRA can be an expensive deal because you got to treat your employee the same as you treat yourself. And all of a sudden that might mean there's a lot of money. I'm trying to put money in my pocket, but now I got to put the same amount of money into all of my employees' pockets there. And that could get expensive if you got 5, 10, 50 employees. So another version of what I'd call a JV version, a junior varsity, since we're in the football season now, and is a simple IRA. And that word simple tells us everything. That's basically a slimmed down version of a 401k, but it's really good for employees when you've got 5 employees, 10 employees, and you got a growing business, and you want to treat yourself well and you want to support your employees, but you may not necessarily have the cash flow to give them the same dollars you're wanting to try to give yourself, and the like. And then there's, of course, the 401k, and that's the bigger one. That's the one we know. But with that tends to be some more complexity and some more costs and things like that. So I want to just share with that is whatever stage you're on, let's talk with you about that, because the 401k is what we know, but there may be others that are more attractive and fit better for your business. And it's really important to have a quick dialogue on something like that. Now, let me stop in here. I come from this background early in my career, so I've seen it. There'd be a lot of life insurance agents selling you a retirement plan using life insurance. I just be careful on that. Let's talk to somebody else on that, because ultimately it sounds great, but in my experience, more often than not, the promise and the outcome doesn't always match in there. So I just put question marks on that. Follow up with somebody in addition to a life insurance agent and look at that and find out what's the need and purpose for it. You'll hear me say that all the time in there. So just want to say what kind of gets sold a lot may not necessarily be what you need in your situation there. Lastly, charitable planning. Go ahead.
Sorry, Steve. It looks like Dawn Nicole has a question. Hey,
okay.
Dawn.
Hey, Steve. So yes, someone sent me a direct question, so I'm now sending it to you. And then there is a second one too. So 2 questions. One is the direct one. So the business owners on this call, one of them are asking, when it comes to like retirement plans, is that more so for our employees or is that for a business owner? Basically, it looks like she's asking, does a business owner themselves need a retirement plan if they invest in their business properly?
I would say yes, because it's a great way to diversify your wealth over time. Take, early on in the business, you're putting everything in the business, but you want the business to start giving back to you and diversify and create additional streams of income, additional sources of wealth, things that aren't as dependent on how the business goes. And a retirement plan is a great way to do that, to take some of the capital out of the business that you've worked so hard to build and build for the future, to the future that you're looking for, which is when you either sell the business or no longer running the business or giving that to the next generation or whatever you want to do with your business there. And a retirement plan is a great way to foster that next phase of your life, oftentimes retirement. And no matter whether it's just you out of your business or a small strip shopping center in Colombia or wherever, depending on the size and scale of the business, there are multiple different types of retirement plans that can be customized and fit to what you're trying to do. And one of those key benefits that Molly can help you with is, let's take the success we've had, but let's knock down the taxes and have Uncle Sam take less of our hard-earned success. And one of the ways to do that is investing in a retirement plan and saving those tax dollars there. So the point is, wherever you are, could be a different retirement plan for you beyond just the 401k. And that may be supporting you, that may be supporting employees. It depends on what your goals are, it depends on where you are. There's the answer to that question.
That's good. And then the second question, and then we can move on because I know you've got more to cover, is if you feel comfortable answering, someone asked, Naila asked, what is your opinion of Primerica?
I'd say Primerica fits in certain circumstances there. I'm going to put the CLA hat on. I think you're going to get a lot more breadth and depth and comprehensive nature of advice. If you get somebody that does a good job, candidly, if you get somebody that does a good job truly building out a financial plan for you, then the products itself figure themselves out, whether it's a retirement plan, savings account, whatever. All those things kind of work out of the plan. Sometimes with firms, the product drives the plan. Does that make sense? The thing that they need to sell to generate the revenue, it becomes the solution. We figure out how to make that the solution. And sometimes that can happen, whether that's with Primerica, whether that's Morgan Stanley, Truist Bank, whatever, that can happen with that. So I think it's the quality of the advice more than the name on the firm there that's really critical there.
That's a good answer. Thank you so much.
Okay. Let me chalk over. As success grows, a lot of you are charitably minded. They're one of the easiest, and people ask, what kind of trust do I need to set up? Before we get into the complexities, I always try to follow the KISS principle. For many people, call it keep it simple something. For me, that's keep it simple, Steve. And one of the simplest ways to support charities is what we call a donor advised fund. That's the easiest way to be tax smart and support the charities that are important to you. And we can dive into that deeper for you, but it's a wonderful tool that's out there for you without complexity and with tax benefits and important benefits if you're charitably inclined to do so. Let me shift over to the right side of the screen. I want to hustle here a little bit. Lots of times we think estate planning, and estate planning is for the mega rich and whatever else. No, estate planning is for everyone on this call. And we just want to make sure that we're hitting the purpose of that. Everybody needs a plan. It may not be complex. As Dawn was saying, once you blow this thing up, at the bottom, that last point is you blow it up and this business is just massive and you're on the cover of Forbes magazine or Fortune or whatever. There's going to be more complexity. There's going to be a lot more trust. There's going to be a lot more things there. But that's the future. For everybody, though, you need a will. And the reason for the will, for the most part, is that you're protecting kids. You're naming who's going to take care of kids. And all too often we focus on the business, and that kind of like, no, your family's not going to take care of the kids. I'm going to, all that kind of family dynamics gets in the way of these things oftentimes, but you got to have it. You got to have a will to take care of the kids and who takes care of them. The easy part, though, is most of the things that the will does, saying, how do you get the money I've made, the business and other things, to my kids or to my charity or spouse or whoever it is, most of that's done for you when you name beneficiaries and setting up the accounts properly. And we can talk about that done. So it's not that complex. But for business owners, a version of a will that's even better is a revocable living trust. And that's a little more complexity, but it gives you three key benefits that I highlighted. One, it's a private document. Anytime you see the Prince or Tina Turner or whoever, XYZ celebrity, what they had in their will, it's because they had a will. And if you're a business owner, privacy is important. A revocable living trust is a way to get a will, but make it private for you, from your business partners, from your subcontractors, whatever it might be. It avoids probate, and that is a big deal that we talk about. And for a business owner, I would say that is your primary tool. That's that third P for you in there. Molly, I'm taking up too much time, so let me try to pick up my pace. Let's see if we can go to the next page here so we can get to questions and I'll kind of move forward. But here are the things, and you allow a little bit of flexibility with how we spell things. But since our themes in our key logo is a bike, I went with the term derailers. If anybody rides your bikes, that's what changes the gears on this. But I looked it up and Googled it, realized I've been spelling it the wrong way the whole time, apparently. So I put in both. I put in the way Steve Powers from North Carolina spells things, from rural North Carolina, to the way it's actually spelled. Oftentimes that's very different. So I laughed at myself there. But here's some of the things that what we want to try to show there was, in running hard and running 100 miles an hour, sometimes there's some things that if we can do little things, prevents us from derailing the business and creating a lot of problem down the road. That could be hiring great people. That could be hiring for, as Ada said, and a couple others put in there, that could be hiring, doing good bookkeeping along the way and simplifying your life. That could be a financial plan. But being aware of the goal, being aware of what's the challenges and risks, and talking with Stephanie's and talking with Steve's and the Molly's and those, and talking with your other trusted advisor and having your plan and working with Dawn to do that, that's so critical to avoid potholes down the road. One of the biggest potholes that we come across in this day and age, in this digital age, is credit hack. Is somebody hacking your credit, somebody getting in there and messing things up for you. And man, you're talking about spending days and weeks and months rebuilding from that problem. An easy, quick solution for that is to freeze your credit. And I've got a link in there. If we share this, it's from Clark Howard. It just protects so nobody can take out credit in your name and kind of mess things up and hack you, create a hack for you that's just going to derail your time and effort and money's there in there. So that's a simple 5-minute fix that solves a lot of problems for folks there. The liability protection. This is a major problem that we have. Liability, people like to sue business owners. And so creating some liability or an umbrella coverage when your homeowner's insurance is an excellent way to give yourself some extra key protection there from the lawsuit happy environment that we live in. Having enough liquidity, having enough in the bank to handle the short-term cash flow situations, because banks only want to lend when you're doing well. When things get tight, they don't want to lend. Is a truism there. So just making sure you got that liquidity, working with Stephanie and the business planning folks there to manage that is so important. And then think in advance, buy-sell agreements, especially if you've got a partnership or anybody else involved in the business. What happens if one of you wants to walk away? What happens if one of you passes away? Things like that. Not fun conversations, but boy, they create stress, and getting them done and understanding them in the future. And oftentimes funding those with life insurance is one of those tools that does that. Those help a bunch to kind of solve problems down the road there, if you will. Ada's right. Social Security numbers get stolen. Froze one of the credit bureaus. Ada, just let us know in the chat. Once you froze one, if you'd let us know if that was fairly easy to do or not there, to get that done once you did it the first time there. And I'll wrap up and hand it over to Molly here for a second. But Ada was asking about charity, a tithe. What's the best? And that's fantastic. What's the best way to tithe out of the business? A donor advised fund is a good way to transfer the monies directly into a fund to get the charitable benefit, the charitable tax benefits of that, and then tied to your church or charity or whatever else. Here's the nice thing that saves you and Molly time. Those of us that write, a tithe out of our business checking account or our personal checking account to the church, and we do that 52 times a year, and we give money to the Girl Scouts and whatever else. Then we got to find all those receipts and get all those 1098s. I think that's the tax form, and hand all those things and find them and forget about some in February of next year and give them all to Molly. What you do instead is that donor advised fund. When you put some money into that account, doesn't matter when you send it out or who you send it out to. Once you make the contribution, you get a letter that says I made a contribution, and that's all that you need to do to report and get the tax deduction. So it makes tax reporting much, much easier along the way, and it's an easy way to get full credit for the good things you're doing there, if you will. To the extent of the donor advised fund, just make whatever you do, it works. Doesn't matter size and scale, and we can talk about that, and I can follow up with you on that separately there if anybody wants to talk about that in part of our follow up, if you will. So let me stop, Molly, if you want to take over, because you've got a ton of great stuff as well. And so sorry for dominating.
Yeah, sure. So let me, if you don't mind, let me just kind of piggyback off, like before we go into more tax perspectives, talking about charity. So I think a takeaway with the donor advised fund is what it does is the minute you give that cash to the donor advised fund, that's when you get the charitable deduction on your tax return. It's not when the money goes to the actual charity. And that is a tax planning strategy. If let's say you sell your business, you're walking into a bunch of, taxable income this year, and rates are, high right now, and they're expected to go down. And I'm not saying they are expected to go down, but like there's a bunch of things that can change. But I think the takeaway is that it can be a planning strategy. Your taxable income is high and you're very charitably inclined, maybe consider donor advised fund, just something to ask about. As far as I think the kind of general question too on simply donating from the business, what I want to be clear on is that charitable deductions, either through your own business, through another business that maybe you have ownership in, you personally, they all end up in the same place. Now, if you have a C corporation, that's different, but I'm talking about small business owners, which are usually not large incorporated C corporations. So they all end up in the same place. They end up as an itemized deduction on your tax return. It doesn't matter if it's paid out of the business, generally speaking. So that's kind of what I want that takeaway to be. So hopefully that addresses the questions there. So let's kind of go on. So tax perspectives, I'm going to hit on some very foundational things. I can get very tax geeky very quick and talk fast. So I'm going to apologize, but I know this topic will probably generate a lot of questions, or if not, sink in, have questions later. Again, empower you to ask questions now or later. So rule number one, I know a lot of you probably, you have your LLCs, you probably know you have a bank account, but what I want to express is the why around that, right? And again, this group I know is all about empowering other women. So while you know to have a business bank account, you might be networking with other women. Express to them the why, like they're starting their own businesses. Why do they need that business bank account? So from an IRS perspective, they can actually come in, and if they start to see, and think about this, a lot of small business owners are generating losses, right? They're funding their business with their personal money. They're generating losses to get it kickstarted. The IRS can come in, and if you don't have that separate business bank account, they can say, you're commingling funds here. This really looks like a hobby, and hobby losses are not deductible. So just something to kind of consider. I've never seen the IRS question anything, but it's still, there's a lot of case law around that. So I would just be mindful. Second thing that I want to cover is just entity formation. I think this is a basic conversation, or so I think, but hopefully I'm going to hit on some key points that can help you all kind of understand how your entities are taxed. So generally what I see with closely held businesses, if you've got an LLC, single member LLC, meaning you're the only one that owns this LLC, that by default is considered to be a Schedule C on your personal income tax return. And what I want you to be aware of is that that income is subject to not only income tax, but subject to self-employment tax. So think about, I know many of you have probably, been able to leave your I've heard this story a lot with you all. It's like leave your corporate jobs, right? So you used to get a W-2. On that W-2, right, you had FICA and Medicare taxes. So now if you are self-employed, that Schedule C income is subject to not only the employer portion, but also the employee portion. You get some deduction, but at the end of the day, it's a considerable amount. It's a cost. So that takeaway number one, subject to both of those taxes. A lot of times these LLCs can elect to be treated as an S corporation for tax purposes. What that means is a separate tax return is filed for the S corporation, but you as the business owner receives what's called a Schedule K-1. The Schedule K-1 is then reported on your personal tax return. So the same amount of income is still flowing to you on your personal income tax return. The reporting is different. What's nice about the S corporation is it's not the taxable income there is not subject to self-employment taxes. So there's a strategy there, right? Like depending on the amount of income you have, it could be advantageous to become an S corporation. Again, being mindful. You might have more questions like, well, why? Just be mindful of that. So again, I note there that there's a cost savings, potential cost savings on the self-employment side. But remember too, now you've got to pay yourself a reasonable wage. Now you have to have payroll. So there's a cost to that. You have a separate tax filing. That's a cost to that. So there's kind of a cost benefit analysis that needs to happen. Whenever I've kind of given guidance, people will say, well, when should I consider my Schedule C, to turn it into an S corporation? There's a lot of, the fact pattern is different for everybody, but generally speaking, I say like, let's think about if it's $100,000 or more. We can still evaluate, but let's just kind of think about that. There's some current things in the tax law that make that go down a little bit. But just when in doubt, ask the question. Let's see how okay, 7 minutes, good. So then I want to hit on this. This is crucial. So kind of a con to an S corporation. I saw people in the chat before talking about real estate. What you really need to be mindful of I can't necessarily give legal advice, right? I'm a CPA. But I will speak to what I see with businesses is oftentimes they will have their real estate in a separate LLC than the actual operations. And I can't remember who mentioned it before, but starting up having some real estate business and the laundry service, two different activities. I would think generally what I see from a legal perspective, that would be separate. Maybe the operations piece you would consider an S election for some savings, but again, we need to navigate that. From the real estate side, that is an asset, right? It's an asset that is likely going to appreciate. The value is going to kind of go up and down, but overall, it's probably going to go up over time. If you were to, I guess here, we would never recommend that you put appreciable assets in an S corporation. Two reasons. Well, mainly one, but if you were to ever distribute that property to yourself, to use it as part of a partnership with somebody else, that is a taxable event. You are taxed on it at the fair market value. So now suddenly you've got to report a gain on your tax return. You didn't receive the cash to pay that tax. So so that is definitely a con. So I think it doesn't allow for flexibility of use of those appreciable assets. So just want people to be mindful of that. Let's see, any other questions right now? Okay. Let's talk about this, tax minimization. I think a lot of people will refer to it as tax planning, but I kind of like to approach it with like, I think it's healthy to pay some tax. And I want to get into the why there. I have a smiley face next to it that says paying tax is okay, and there's a reason for it. So when it comes to tax planning, we're all about trying to minimize. So let's kind of, what I try to express to people about paying taxes okay is that, it's that concept of we never want the tax tail to wag the dog, meaning we don't really want tax considerations to be the only reason why you're choosing to do something. So an example of that, like if I'm a business owner, I'm saying, well, if I buy a new computer, I'm going to get a write-off. I'm going to get to take that as an expense. Great. And I'll save some tax. Let's pretend your tax rate is 25%. So I spend $100 on a computer, let's say, for simplicity. That would be such a deal, but I'm going to spend $100 on a computer. I'm going to get the tax deduction. I'm going to save 25 cents, but now, or $25, but now I've lost the other $75. Did I really need that computer? Should I have just paid the tax on that income and been able to hold that $75 and do with it what I actually need to? So hopefully that kind of concept is kind of a light bulb for a lot of you. So kind of just getting back to, I think it's healthy to pay taxes. We just want to minimize. We can have crafty strategies as wealth grows and things like that. But at the end of the day, generating a tax deduction is going to be you relinquishing the cash. And honestly, surrounding yourself with a good advisor that is up to date on tax law changes. And we've seen so many changes in the past several years. Tax reform really wasn't happening a whole lot. The last time was like 1986. And in the past several years now, since 2017, we saw the biggest changes. Since I've been in my career, I've been doing this for 13 years. 2014 was a big one. 2017 was a major one. And it's just, I don't think it's, especially with the elections and things like that, I think it's just going to be, it's just going to get more intense. So having an advisor around you that is up to date on the current law, maximizing your deductions based on the current law, I think is crucial. Any questions right now?
Yes.
Okay.
Yes, I was just waiting for a stopping point.
Thank you.
No worries. So really good questions. By the way, thank you. This is helpful. So one question was, hey, question, when an LLC, small business, provides discounts to nonprofits for like pricing and things like that, is there a strategy that we can utilize to benefit for tax purposes? That was question one. I'll let you answer that. And then there's one second quick question too.
Yeah, so that's actually usually in the tax area, it's always like an it depends. This is one where it's not an it depends. Although I guess I will say it, generally speaking, doing that will not give you, you're not going to be able to claim there's no benefit.
Okay.
It's not, I'll just leave it at that.
Okay, because we could go into a rabbit hole, I'm sure. With
exactly.
That. Okay. All right. So good answer. Second question. If we have not begun to pay ourselves, but gaining funds for the business, are we considered self-employed?
So maybe I have more questions around that specifically. I'd want to understand, are you an LLC or are you an LLC treated as an S corporation? So that would be the first thing.
Looks like she's an LLC.
But isn't an LLC taxed as an S corporation?
Not sure.
I know. See, with taxes, it's so like fact, and every fact
okay.
is different.
LLC only. She just said me. I know it seems like I'm making this up, but she's
no. You're good. I'm so single member LLC, Schedule C on a 1040, like your personal tax return. Okay, so can you remind me of the question?
Yep. Question was, hey, if I haven't started to pay myself yet, because I'm still gaining funds or ramping up, does this just make me self-employed or?
Yeah, exactly. So to me, that's a Schedule C. You don't need to pay yourself a wage. You don't need to have payroll for yourself. It's just going to be considered self-employment income, all of it.
Perfect. Awesome. Thank you.
Yeah, sure. Okay, so the last thing I had mentioned was maximizing deductions based on current law. So I want to hit on a couple things about current law. So I said that a major shift that we saw was the Tax Cuts and Jobs Act of 2017. A lot of the items in that are set to expire at the end of 2025. So that's coming due pretty soon. One of the things in there is the qualified business income deduction. So what I want you to do is kind of in with a few things that I'm going to talk about here is go back to your own tax return. Page 1 of your personal tax return, there's a line item that says qualified business income deduction. Do you have anything there? If you don't and you're a business owner, I would ask why I don't. So whoever you've worked with to do your return, like understand that number, because I've actually worked with clients before. They've come to us, I've done a second review, and there's some nuances to that code section. And you know, I think recently I saved somebody $25,000 just by filing an amended return and checking the correct boxes. So being mindful of that, because that's something that's set to expire. And remember, we have 3 years to go back and amend returns. So be mindful that that exists. Bonus depreciation. I think over the past several years, we've gotten so used to just writing everything off. I buy a piece of property, computer, whatever equipment I need for my business, I'm going to write it off. The truth is, as tax advisors, CPAs, we've been able to write these things off through accelerated depreciation methods under the tax code. So bonus depreciation is a big one. And I'm only going to talk about that one right now because it was at 100% for a long time. And last year it went down to 80%. This year, 2024, it goes down to 60%. And it's going to graduate down to 0, I think at the end of 2025. I can't remember, but what I want you to be mindful of is that number's going down. And that's important for people. There are other ways to accelerate depreciation, but those rules still are constantly changing. So this is the big one that I just want you to be aware of. You know, simply thinking, oh, I'm going to buy this car, I'm going to buy this piece of equipment, I can write it off. Because again, we've all as tax preparers have been saying that. Just remember it. Gifted estate taxes, kind of like why we're all here too, was to talk about like some estate planning. And what I just want you to realize here is that well, let's talk about 2 key things. So gifting, you can make a gift to somebody that's not taxable if it's under $18,000 per person. Just nice to know. And then from when we talk about a taxable estate, as of right now, that would be considered, generally speaking, anything over like $11 million, let's say. What I just want you to be mindful of as your businesses continue to grow, these laws constantly change. So just think taxable estate. Molly says it's over $11 million right now. I'm okay right now. Maybe you don't need some intense, complex estate planning, other than kind of those basic things that Steve was talking about. But just knowing those amounts can change. So just being mindful of that and keeping some of these basic questions, just bringing up with your advisors, and actually hope if you've got a good advisor, we're talking about this constantly. Let's see, where are we? Okay, takeaways. So speaking of advisors, if you can establish good relationships with your advisors early on, I always think about it like if you're in talks with, let me take a step back. So just having a table, that's what I wanted to get at. Just building the team at your table. And oftentimes it's not just, so I think about me and Steve, right? We work seamless here. We have mutual clients. He deals with like the wealth I come in on the tax side. And together we're discussing the impact of a strategy, right? There's more voices that need to be at the table than just your financial planner, than just your attorney. So just building a trusted advisory group around you. And I think trusted, and I'm going to use something I have learned in therapy so much over the years, is just feeling that there's no judgment. You should feel so comfortable to ask your advisors a question. And I think just not feeling any judgment from them just kind of means that you're building that you guys have that trust there. And I think that's very important.
And I'll jump in, Molly, I'll jump in because we were talking about this earlier. At the bottom right, it's shocking to me, but New York Life does some great surveys, and I put something in the bottom of that screen there. It's getting worse for women in terms of women are responding that they're feeling that their advisors treat them differently if they're a woman, and that they feel patronized by advisors. And what New York Life found is over the last 6 to 8 years, that's gotten worse, or they're feeling worse about that. So point being is, whether it's Primerica, whether it's CLA, whether it's whoever, you know, find the advisor and advisors, whether it's your banker, your attorney, your tax advisor, your wealth advisor, your the Dawns of the world there, the Stephanies of the world. Find the ones that support you and then get rid of the others. And it's a shame that half of the women in that survey are saying that they're feeling patronized. That's ridiculous. But that's obviously a reality. So find the right people, build around it, because the success and complexity is only going to continue to grow. And it's a shame that half of the women, the respondents, say they're feeling patronized by advisors or financial advisors. That's embarrassing, and it's a shame. So move on to the next one until you find the right one or the right group there.
Yeah.
I think Dawn's got somebody's got.
Oh yeah, go ahead.
Yeah, I really love that you brought that up, Steve. I didn't know y'all were going to talk about that today, but if I could just very, very quickly on why I appreciate CLA, I actually had a situation where the one time I was ready to start taking money seriously and my portfolio seriously, and I was like, okay, I'm a big business now. Let me reach out to a financial advisor who was a male, right? Steve, not right. We love men, so not bashing. What happened for me is I was trying to be independent and really protect my assets. And when the person responded back to me, he automatically, without my permission, included my husband, who I didn't talk to about it yet. I was trying to take a step and make a step, and we differ. We differed at the time about investing, and we had different behaviors. And I felt so disrespected that he took it upon himself, because you don't know if I was unsafe. You don't know what my plans were. I could have been a woman leaving a spouse I wasn't, but these things are important when it comes to the safety of women, right? And these little slights, suppose I was trying to, you know what I mean? And it created a bad situation, because then my husband was like, what do you do? And I was going to tell him after I did, you know, how we do, we buy the dress and then say, oh, I bought a dress, right? I was going to tell him, but I didn't appreciate, I felt he was so insensitive. And would you have done that if it was a male? Would you have included his wife? Right? No, probably not. And so I'm just speaking on that, Steve, because I remember giving feedback to that advisor, and he didn't see what was wrong. He didn't see it. So I appreciate you bringing that up. That's a very real thing to consider. So thank you.
I will say that I also love that because I was going to ask that question, did you get that feedback? And I'm so glad that you did, because some people just, they don't see it. And so, and that's an uncomfortable conversation, but we have to be willing and feel empowered to have those uncomfortable conversations. And that's the way we drive change. So I love that.
Thank you.
So I want to, this is such a fun topic. It should have been like 2 hours. But let's see. So just how CLA can help. I think you guys kind of all get the picture. We work very seamlessly. There's a lot of, where we can be here, you know, from the beginning, of your journey, all the way to looking at ownership transitions, right? You get to the point you want to sell your business or whatever. We can just do so much. What I just want to hit on is that it all starts with a conversation, making yourself, I don't want to say available. What's the word? Being okay with asking the questions. Just start the conversation. So I just want to say to you, like when it comes to tax returns, always willing to take look at that and give you like a second opinion. It probably takes like 5 minutes, you know, and maybe there's nothing there. Maybe it's just asking questions and just go from there. At the end, I just kind of want to say, back to the bike, just to circle it out, it all takes balance.
Thank you so much, Molly and Steve, for giving the wealth of knowledge on their personal financials. And team, one of the things that I would say in the essence of CLA is we serve privately held companies. So we're not going after the big box. It's mostly family-owned businesses, first, second, third generation. And even in our wealth advisor, Steve is actually it's my wealth advisor. So, and he was my wealth advisor very early on, and just the conversations before I became principal was so essential for me. And the thing that I like about the wealth advisor is they're not commission based. So I would say whatever advisors you have, from banking, attorneys, financial, insurance, and all of that, make sure you trust them, right? Because you have to have vulnerable conversations with them in order to receive the benefits of the advice and to help you grow. So it's okay to interview advisors. It's okay to get second opinions. It's okay to ask clarifying questions because an advisor should be there to support you. So we enjoyed our time with you. I think this is one of many. Don Nicole and I said we may do a live session at some point throughout the year or maybe next year, but if you have any questions in the meantime, feel free. I'll put our link up again. And are there any questions in the chat while we're still here? We still have a few minutes that any of the topics that Steve and Molly covered that you wanted to go in detail with?
Yes, we do have a few questions. Some of them are for me. Yes, ladies, I will put this on YouTube. Everyone's like, are we going to get the replay? I promise we will edit it quickly and get it this week on YouTube and let you all know. But also I think there was some more clarity. Like, so our women are very interested in paying themselves, because I want you all to remember this particular audience is an audience who our main majority has been in business 2 years or nearing that 2 years. They've already sort of operated like a small business. So they're starting to look at, okay, do I convert to a S Corp? So I think this is why this paying myself is still of interest, because they're scaling up. And so if we could just talk about, if y'all don't mind, what is the process of flipping into an S Corp if you're not one? That's one. What is that like? How much time does that take? How disruptive is it, or beneficial? That's one. And I know we could get into a whole hour here. But then also an LLC, do they need to start practice paying themselves, although they're not required to? Do they? Okay, go ahead.
Yeah. So an LLC, and forgive me, I still think after 7 years of having a child, I still have mom brain. It will always happen. So you're going to probably repeat that first question. But from with an LLC, right? If it's important to say you're an LLC, but what you need to distinguish is whether or not you are an S corporation or not. And if you're not, you're likely just going to be a Schedule C. So I would refer it to it like that. That's the best way to understand, because if you're Schedule C, you're not paying yourself, because it's all just taxable income. The net bottom line is taxable income. It's on your personal return. The S corporation, the taxable income there is not subject to that self-employment tax that I had mentioned. So really think about this. Your taxable income is probably your net cash left over at the end of the day. Generally speaking, these are cash basis businesses. So your revenue comes in, you're paying all your expenses, cash in the bank, cash out of the bank, you've got a residual. You want to take money out of it, you have to live. So generally speaking, what you're taking out for personal use is your taxable income. So actually remember that, because that lets you know kind of whenever you're taking dollars out of your business, think about, I need to set aside at least 25% of that for taxes. Any dollar you take out. That's like a good kind of takeaway. What was the other part of the question?
Heck, I don't know.
Maybe I answered it.
So I'm like, I don't remember. I think you answered it. I think the question was around, do they need
S elections, how complicated?
Yes.
That's what it was. From a tax perspective, it's a very easy process. We can even file like late S elections, but that's usually if you come to if you were to come to CLA and it's already past the window, you have like 2.5 months. So let's say you want to be an S corporation effective 1/1/2025. You have until like March 15th to file that. Or no. Sorry. Let's say you want to be an S corporation for all of 2024. You really need to have made that S election back in March. But we can file late S elections. They're just, I guess it's easy from our perspective. But from a business owner's perspective, you've got to, if you haven't already, you'd have to establish a relationship with a payroll company, because now you have to pay yourself a wage. Some of your income that you're taking out of the business has to be subject to those FICA and Medicare taxes. So you have to pay, and that's a whole other conversation. What is a reasonable wage, right? but from our purposes, S elections are very straightforward.
So I definitely see the next webinar. We're going to go deep on S Corp related.
Taxes. Oh, I got it.
Let's
I love it.
Yeah. This is great. Are there any final questions before we close? I think Takesha,
there was one.
Yeah, there is one great question. I think so Takesha asked one and then Chef Maria. Do y'all want to just come off mute in the interest of time? So,
okay, and Ada asked one as well.
Okay, go ahead and take us away, Steph. You can answer or moderate any. Yeah.
Okay, so I'll answer Ada's really quick. In regards to sales tax, I will definitely say let's have a deeper conversation offline, because sales tax rules are going to depend on number one, where you're located, where your people live, where the projects are, what the materials that you're buying. If you have reseller certificates, we have an entire team dedicated to sales tax because it changes by state. The state laws will dictate what is called nexus, and pretty much is essentially whether or not you need to file. We do those first consultations to get more information about your client or about your company for free, so that way we can guide you if there are any implications. So definitely reach out on that. And it's very complex for general contractors, just to let you know. So don't do it alone, but we can advise you.
Wonderful. And can I just say, you all have been excellent advisors to QCWIB headquarters as a company as we grew out and branched across chapters. So they know what they're doing. I've just put their contact info in the chat. You all want to schedule a consultation. I think, Chef Maria, we have time for one more question and then we're going to close out.
I think the contact information will handle it, because I've been at S Corp for years and transitioned from being product-based to service-based, and I'd like a second look at everything that's been done. So